In this video, I want to talk about how I go from coming up with a trading idea or thinking up a trading idea to then programming it and then backtesting it and hopefully going through some sort of a strategy development and coming up with something that will continue to make money into the future. The strategy that I'm going to show you works on Euro-Pound forex pair, but the principles behind the idea and the development apply to all forex pairs, or all markets in fact, and I would take the idea and I would test it on each individual market to see which one works. The strategy works on a combination of 2 or 3 ideas. However, the main idea or the main focus looks at the weekly bars of the forex pair. So we're looking at a weekly chart and then we're looking at the previous 1 weekly bar, and specifically we're looking at the relationship between the open and the close to the high and the low of that 1 bar. And I'm going to demonstrate exactly how to use this idea in a moment over on the whiteboard. My thinking is that when we're looking at that last weekly bar, so we're moving into the next or the coming week, and we're looking at last week's bar to see what the price action was of last week. My thinking is that if we're looking at, let's say it's a candlestick bar, then we're looking at the height of the overall bar and we're looking at the body of the bar. My thinking is if the body is very, very narrow, that's the open to the close, then what's happened is the market has moved around quite a lot throughout the week, but from where it started to where it ended is a fairly similar price. So there's some sort of indecision. It didn't know which way to move. So my thinking is if that happened last week, then this week, then the market is likely to have a bigger move or a bigger trend in one direction or another. Once we've seen the setup, so once we've seen a narrow body on that candlestick, then the coming week the entries into the trades are really simple, and this is where idea number 2 comes in. And I've just kept this very simple, but I would like to test other ideas too. But for this strategy we're just using a simple idea and a simple trading day of the week idea. Now, markets tend to rally more and decline more on certain days of the week. I can show you a study proving how this works. So the first thing we do is we look at, is there a particularly strong bullish day of the week? And is there a particularly strong or particularly weak bearish day of the week? And once we've found a strong bull day and a weak day, then they're our entry points. So we literally, let's say that Euro Pound is particularly strong on a Wednesday, then once we've seen the weekly bar with that narrow body, then we just go long on the Wednesday and then exit first profitable close. That's the bailout exit I picked up from Larry Williams, where we simply wait until the end of the day or the end of the session, look to see if the trade is in profit. If we're in profit, we exit and take the profits. If it's not, we leave it running and we'll either get stopped out or we might take profit the next day. I've found on average that each trade only lasts about 2 or 3 days. So let's go to the whiteboard and I'll explain that weekly bar setup. As the new trading week starts on a Sunday for Forex, we're going to be looking at the most recent weekly bar or last week's price data to see what happened overall on the week. And so we're looking at the weekly bars. I've just drawn some candlesticks and you'll notice that the range is all the same. So the high to the low all looks the same, but the bodies of the candles are very different, and the bodies represent the closing prices and the opening prices. Now, as I've already said, my thinking is that we're most likely going to get a better trade or a better trend, so we only want to go when there's better trades or better trends, if the past week had a narrow body. So what happened was prices bounced around during the week, or they opened, bounced around from highs to low, and they closed very close to where they started out. So the prices couldn't make their mind up, and next week we're more likely to get a bigger rally or a bigger decline. When I programmed this into Multicharts to test this strategy, Multicharts is the software that I use, I simplified things and I've called it bar 1, 2 and 3. Now, the way that we do this calculation is we look at the overall range, so the low to the high, and let's say for example the low to the high had a range of 90 pips, and what we do is we split the body into thirds. So if we were going to get a candle number 1, what we're saying is the distance between the open and the close is less than a third of the body size. So in this case, a third being 30 pips. So this body, the open to the close, is less than 30 pips. If it was number 2, then we're saying that the price of the body, or the distance of the open to the close, is within 2/3 of the range. So it's above 30, but it's below 60. Okay. Candlestick number 3 is the body, or the open to the close, is above 2/3 of the overall range. So it's above 60 pips in this case. Okay, so we've split them into thirds and we've called them 1, 2, 3. As I said, I would expect the narrow body to work best, but I don't know. We're going to test that. So that's the setup bar that we're going to use. Once tested, if it is number 1, we're only looking for trades the following week if we've got a weekly candle the previous week that looks something like that. Now, let's go over to the computer and we'll find the best days to actually take the trades. So we look at the trading day of the week bias, and then we'll test out 1, 2, 3 different styles of candle and see if we can make something work. In the first study or workspace then, we're looking at the trading day of the week. Is there a day that's particularly strong every week, or is there a day that's particularly weak every week? And we're going to work that out. We're going to be using data from 2008 through to the end of 2018, and then that gives us some unseen or out of sample data from 2019 through to August 2021. And we can test out our strategy once it's been developed on that unseen data, because that's a good way to tell whether or not the strategy is likely to continue to work in the future. Obviously, it's not foolproof, but it's a reasonable way to see if we've overfitted or curve fitted the strategy. So let's have a look at those weekly biases. I've run a piece of code which buys at the start of every day or the start of every session, and then it sells at the end of the session, and it does that for each day of the week. And looking at the numbers, looking at the net profit, we can see this is a particularly strong number, 14,000, and it's on day 4, which is Thursday. So buying on a Thursday and exiting 24 hours later produces £14,500. So that's going to be our bullish day or our strong day. And if we look at day 2 or Tuesday, this produces minus £7,400. So that's going to be our bearish day, because if we bought at the start of the day and exited 24 hours later, then we're going to lose quite a lot of money. So that says to me that that's a bearish day. The other days, Monday, Wednesday, Friday, they're fairly neutral. There's no big winners up or down. So we're going to use short on a Tuesday, long on a Thursday. In this workspace, I've inputted going short on the start of the session on a Tuesday, long on the start of the session on a Thursday, but only after we've got a weekly bar which has got the narrowest range. So a weekly bar, I've called it 1. So the price of the open to the close is less than a third of the whole range of that week. And if you see in this lower pane, I've got a weekly candle here. We can see that the body of the candle, this green part here, is very small, less than a third of the size of the overall candle. So we were allowed to trade. If you notice on this next week, which starts here, we didn't take any trades because this part of the candle, the body of the candle, was greater than a third of the overall size of the candle. Okay, let's look at those results. Now that's the equity curve, which is quite nice. I like that. Total trade analysis shows an average trade of £87. I'd like to see that slightly higher, but I do like the consistency of the curve there. But as I've mentioned, that's using the weekly candle with the body less than a third of the overall range. But perhaps that isn't the best, so I've actually tested that. And we can see that I've called it a weekly range rate, and at the moment we're using a weekly range rate of 1, but we've also tested 2 and 3. And we can clearly see that 1 in this case does make most money. 2 is bad, and 3 is actually slightly better than 2, but it's certainly not the best. So I'm very happy to say that we're just going to stick with that narrow body for the weekly range. In this next workspace, what I've done is I've wanted to look at the weekly bars, and I wanted to look at how the close was in relation to the open, as in, did the price close higher than it opened, or did the price close lower than it opened? We're still using the filter, so we're still using a narrow range bar, but we're also looking at the close in relation to the open. So currently, if I show you the inputs, I'm using only go long if the close is less than the open. So I've called it a down close, and we're sort of using the opposite. We're only going short if the close is higher than the open. And there's the equity curve, which is quite nice, probably just as nice. Certainly making some new highs. Let's have a look at the average trade. The average trade is way higher now. We are taking less trades because we're filtering, but the average trade is way higher. I'm quite pleased with that. But let's test the other way around. Maybe that's better. What if we say we only want to go long if the close was higher than it actually opened? And we only want to go short if the close was lower than the open. And there's the equity curve, which I think you'll agree is actually worse. That's worse than the other way around, and it's worse than taking all the trades, I would say. So we're not going to consider that, but we are going to consider taking long trades if the close was less than the open, and we are going to consider taking short trades if the close was higher than the open on that previous weekly bar. So bearing in mind that filter for later, in the next workspace, I just want to check a stop loss. So we're taking all trades now. We're not using that up close or down close filter, but we are still using the weekly range filter. So we're still looking for that narrow body. And let's look at the stop loss. I've checked a stop loss from 0 all the way through to 300 pips. Using no stop loss at all, we're making £31,000, £87 average trade. Using a stop loss does hinder performance slightly, but we do need to use a stop loss. Looking through these, I actually settled on about 180 pips because looking down the net profit, it's increasing. We have got 27 there, 24, 25 the other side of it. As we go a little bit higher, it tends to get a little bit more stable. We've got £72 average trade. I thought 180 is a reasonably stable area, so let's use that. Remember, we have got a reduction in the average trade and a little reduction in the overall net profit. Let's see what it's done to the equity curve. And it hasn't really damaged the equity curve too much. The equity curve's still quite nice, so I'm happy to stick with the 180 pip stop loss for now. The next thing I want to look at is look at the trades with that up close and down close filter and the 180 pip stop loss. There's the equity curve. It's a bit flatter now, isn't it, than certainly without using the filters, but it is particularly strong lately. What's the average trade like? Average trade dropped a little bit to 96. What I did want to look at is the long and the short trades individually. So that's the equity curve for just the long trades, which is quite nice. It's probably better than using both. And that's the equity curve for just the short trades, which really isn't very nice at all, is it? So it looks to me that the long trades are certainly performing better than the shorts. So it looks like trading just long only could be an option, because trading long and short, the trades are actually individual, or the entries are certainly individual of each other, because we're only going long on a certain day, short on a certain day. So we could just trade long only on this strategy. The next thing I want to look at is that unseen data, or out of sample data. How did it perform on the data from 2019 through to August 2021? So let's have a look at that now. But before we do, if you're enjoying this video, then please give it a thumbs up, because that helps out with the channel. So in this workspace, we're looking at the complete data set, so from 2008 through to August 2021. And we're not using the up close or the down close filter, but we are using the stop loss. So there's the equity curve, and that's looking quite good because we can see that we're making new highs into unseen data, which is exactly what we want to see. The average trade is very similar at 72, so that's hardly changed. That's good. £72 is still a little low for my liking. Let's look at the individual equity curves. That's the long equity curve, which is really quite nice. And that's the short equity curve, which isn't quite as good. So we have still got this option of just trading long only. Now let's have a look at the performance report using the up close and down close filters. And we're using the 180 pip stop loss, of course. There's the overall equity curve, which is really good. Look how it's really taken off in recent times, so that's good. The average trade has jumped up. We're now at £126. That's quite good, that's tradable. And let's have a look at the individual equity curves. Long, that's really quite nice. Short, oh, see the short now has actually started working. That's made our equity curve look a lot better. So that's why we've got that strong recent up curve in the equity. I'm really pleased to see that the strategy is working well into the out of sample data, or the unseen data. When using things like trading day of the week biases, it is very easy to overfit, but we can see from the data that trading on the Tuesday and the Thursday obviously has still worked into the future on Euro Pound. We can see that my original idea of using that narrow body on a weekly bar does work best. We saw that in the optimization, and it makes sense. A lot of the times the biggest moves come after some quiet periods. And that doesn't just apply to weekly bars, it applies to daily bars or any size bars really. So we have a couple of options, I think. We can either trade both long and short using the filters, so only go long when the close is less than the open on that weekly bar, and only go short, kind of opposite, when the close is higher than the open on that last weekly bar. And we've also got the option of only taking the long trades too, depending on what you like. Additional elements or additional development features that I'd like to look at with this study are the overall range of that weekly bar. You know, we were concentrating on the relationship between the open and the close to the high and low, but what about the overall size or the overall range from the high and the low? That's something to look at. And also I'd like to look at actually drilling down on the time of the entry. At the moment we're entering the open of the market on the Tuesday or the Thursday, exiting 24 hours later, but I'm sure we can find some better times to actually enter and exit. As usual, as this is a brand new development, brand new study to me, I can't say whether or not it's going to make money into the future, but I shall certainly keep my eye on it, and I'll check back in a couple of months' time to see if it's continuing to make new highs. And if it is, then I'll look to put it into my live portfolio of trading strategies. So I hope you've enjoyed this slightly different idea today, and maybe subscribe to the channel for more trading strategies a little bit like this. But until the next video, this is Jared Goodwin, and thank you.